one.
Good evening and welcome to colleagues, council officers and members of the public. This is the Financial Monitoring Task Group. We will be having a private session at the end of the public session because there are some exempt matters to consider. But until we get to that point, I hope members of the public enjoy seeing your councillors and council officers at work. I think it might be appropriate to now take apologies. Rosie?
You have apologies from Councillor Joan Henry, Chair.
Thank you, Rosie. Are there any conflicts of interest that members wish to declare? No, thank you. I think it is probably worth recording in the minutes, Rosie, that we've lost two stalwarts of our group, Councillor Natasha Irons and Councillor Owen Pritchard are now both cabinet members, so they will be no longer attending the task group. They both made many fine and challenging contributions to our discussions, and they will be missed. So we thank them. I think we will reorder the agenda slightly for this evening with colleagues' permission. After we've considered item 4, which is the Q2 report, we'll just have a short item about for any other business, and in particular to consider a proposal for a topic for review that Paul Kohler has suggested to me earlier. Then we'll move on to item 5, the Malden Town Centre Regeneration, and that will be a public session. And then we will have to go into private session for a presentation, a more detailed presentation by the head of Future Merton. So I think that's the order of business for this evening. Is everyone happy with that? Okay. So we move on to item 3 on the agenda, the minutes of the last meeting, which took place on the 15th of September. Are these an accurate reflection of that meeting's proceedings? Yeah, I see nodding, so thank you. Those minutes are agreed. If we move on to...
Chair.
Yes, Peter, sorry.
So there is one matter arising from the minutes.
Yes, there are.
And that is the reference from this group to the Commission to reconsider the £10 disregard on the DRE benefit. And I don't know whether it's because we'd just been looking in detail at the budget, but members of the Commission were not minded to take that one forward to the Cabinet, as you probably know by now, given the very uncertain nature of pretty much everything at that stage in November. So maybe there would be time to come back to that, but not I think, until we have a clearer picture on the budget.
Yes, I mean, absolutely, Peter. There was, in fact, an action point on Keith Burns to provide information. And I think I'm right in saying, you may need to correct me if I'm wrong, but when the information came forward in financial terms, if we had made an inflationary increase to the disability disregard, it would have cost the council £150,000 or thereabouts. And therefore, the Scrutiny Commission decided as you've just described.
Yes, well, there's some rapid back of envelope stuff, but yes, of that order, they were alarmed to find just how much it might be. So, yeah.
There was a second matter arising on those minutes on page 2, and of course, David Kepler, our head of Revenues and Benefit, has sent an email round on that point, which we can discuss perhaps a bit more when we come to that point in the Q2 report. Okay, so I think we are now at item 4, which is in fact the Q2 report. I'm delighted to see that the papers are a bit thinner in number this time, but I'm sure the quality of the presentation will be equal to past occasions, maybe better even still. So Caroline, would you like to kick off?
Thank you, Chair. I can make it very brief indeed if you would like. I suppose it's just when you look at the papers, they are slightly out of the order we normally present them. So I don't know whether that helps, because you may want to focus in a different way on what the issues are. But clearly we have the debt report, which is showing the level of arrears has gone down slightly, but very slightly since June. But clearly with regards to COVID, there are certain areas where we are not enforcing debt recovery, or we have said we're still giving sort of exemptions to people. And indeed, if you were sort of on the early part of the conversation, we just had our first digital court hearing today for council tax summonses for those who had previously had a history of poor payment of their council tax bills. So we want to take a measured approach to the enforcement of debt recovery, but it's sort of starting at those early stages. And then on page 25, you will see that the main meat of the report that we normally have, which is the detail of the revenue, the capital, and the impact on savings, which also shows the position on our COVID costs. And indeed, there was the discussion at the Commission around the net cost of COVID being 14.3 million. But at that stage, we did not have our sales fees and income grants certified by MHCLG, so that was excluded from the numbers. And indeed, if you've seen the papers for Cabinet on Monday night, 3.5 million has been included in the month 7 estimates. And we are looking to submit a claim for over the next couple of weeks for the second tranche of that income. Clearly, the impact of further lockdowns and potential moves up and down tiers come Christmas time will have further impact on AR expenditure, BR income, and therefore C, the grant claims that we will be able to make. So it's very tricky to be able to actually work out what we will be claiming for based on what we will actually lose. There is the update on the capital programme, and we have been asking budget managers to slip as much of the capital programme as possible, and we've been really onto that very early on with Zoe and her team, because we're just conscious that some of the COVID impacts has made it more difficult to get the schemes going with procurement wise or access to buildings and particularly schools, and therefore we want to make sure that as early as possible we've slipped the monies if those schemes still need to be undertaken into future years, because that then has an impact on the MTFS and the budget and the gap for next year as well. So there's quite a few things that sort of all play into each other. And you'll have the update of this latest position on the savings, monitoring for the 1920 and the current year. And we have made some assumptions around the deliverability of in-year savings in the MTFS going forward. And again, that will be sort of presented back again to you in later versions of the report if you are on the Commission. Probably enough there for me. As you will see that the outturn position moves quite a lot. The expenditure swings quite rapidly, as I said, based on sort of lockdown, various issues, and also sort of the level of income and what we expect. So we have certain tranches of income which goes towards general support of our additional expenditure, and then we've had some very specific grants around either homelessness or the Contain Outbreak Management Fund, where we're utilising that to help with track and trace. So I'm happy to take any questions on the papers as normal. Thank you.
Thank you very much, Caroline. I think it might be appropriate actually to start at pages 26 and 27 as we go through the report. Kind of starting in the middle, but it's also to give us the overview. Because at the bottom of page 26, it says that the adverse variance at the end of September is projected to be 10.7 million. And then on the opposite page, page 27, we have that table. And of course, behind it in the subsequent pages, we have the departmental information. So I suppose I might just ask the obvious question. If nothing else changes, is this 10.7 million a projection of what the loss would be at the year end? And therefore, what needs to happen between now and the year end is 10.7 of revenue or 10.7 of savings, or a mixture of both, have to be found?
So I would say no, because if you looked at the papers which went to Cabinet on Monday night, that had already changed down to 8.2. So that's why I said it's very much still a moving feast. We are expecting some additional income in from the sales fees and charges.
Yeah.
But Hannah Doodie's very clear to point out that we are not at the worst time of year for her service. So January and February are particularly bad time of years when you have the impact of flu, and you're going to have that on top of COVID and potentially sort of further either lockdowns or not lockdowns. So it's quite challenging to be able to work out what that does mean. So, but what we do allow for when we look at what we then need to fund for this year's outturn. So whilst we have the cost of COVID in the table on page 26, there will be elements in there which are taken into account in the MTFS. So the business rates and council tax funding loss will not be part of the accounting loss for year end, but they are part of our COVID costs. So that's what we're sort of working through. So when we get to year end, we will set out what the overall net variance is, whether it's a surplus or a deficit, and how that will then be met and what we're doing about that.
Would colleagues like to ask any questions about this summary overview?
So if I may, Chair. Yeah.
Yes, Peter.
Okay. Yes, there's still a few unknowns to come, aren't there? One would be the view we decide to take on the adult social care precept. And as I think you explained to Cabinet, Caroline, the way in which we respond to the freeze on public sector pay, you said that the council's employees are not necessarily a part of that. So you can say any more about how that will be translated, if you like.
So when we bring the report back to Cabinet on the 18th of January with the update of the settlement and what our gap will then be and our proposals for closing that gap, we will look at options there as to whether we reduce. We've currently got 1.5% in pay award allowed for. We're trying to do some work across London to see what we think from the finance side, as well as them alongside the heads of HR, to see what it's likely to be, to see if there's any room for manoeuvre to adjust that. But that will be done as part of that report. And that won't, from what we're discussing here tonight, doesn't necessarily play into that. But if we do have a gap, then that plays into sort of some of the monies we may have less to play with next year.
And can I just come back on, as a refinement of that, any staff earning 24,000 or less would be entitled to, is it a flat sum increase of £250, around about 1%? I just wonder how many of our staff would fall into that category, actually.
But again, I think that's for staff who are not part of the local government family.
Okay.
So we would need to look at that and see, because certainly all of our staff are above the London living wage. So we just then need to see what that would mean for staff under 24,000. I don't have those numbers, but we can see if that would then apply to us or not.
Thank you.
Paul, Councillor Kohler.
Thank you. Just so I got it clear in my head, what was the 10.7 on page 3, paragraph 3 of page 26, which is now 8.2? That's made up presumably of added expenditure and lost income, is that right?
Yeah.
And the 75p in the pound only relates to lost income, is that correct?
It only relates to lost sales fees and charges, so not any investment income, not any lost rental from our investment portfolio, or commercial income from advertising hoardings.
So it's a subset of income and covers nothing, of course, on expenditure, presumably. It's just for a subset of income.
Yes.
So at the moment, if nothing else changes, we are clearly looking at a serious deficit. What proportion of what is now 8.2 or whatever it is expenditure and what is income? Do we have a rough figure?
Not to hand. We can look to get that to you separately.
Okay, but that's presumably the bit which is definitely missing from everything at the moment. Is that right? The bit which we have no way of, there's nothing from government coming to say how that's going to be funded. Is that correct? So
we will get some additional tranches of income from the sales fees and charges grant.
No, I mean that. I mean the subset, the amount of that which comes from increased expenditure. At the moment, there's no prospect of that coming in at this stage.
No, so we've had 4 tranches of funding to support our expenditure. There will be no further funding for that.
So that's almost a certain that we've got that to find, yeah. Plus 20 or 20% with regard to the lost revenue or the subset of lost revenue.
Yeah.
So that figure would be quite useful if we have that, that, because that's the real figure, isn't it? That's the one that's lurking there to concentrate our minds.
Sorry, I'm just trying to think, just to clarify what you mean by the figure that we...
I'm trying to crystallize the amount which we have at the moment see no prospect of getting. I know there's lots of uncertainties in this whole thing, but I wanted to crystallize what was the amount where there's nothing even on the horizon at this stage. And I know everything is changed because expenditure might go up. It would just be a useful figure to focus on, I would have thought, at this stage. But if you can't do it now, don't worry.
Yeah.
It's just something...
So we're saying 12.9, but that will come down by some further income.
Yeah.
And then that's what we don't know. But we don't know till we put all the income claims in. So that's where it gets complicated by the movements, because the final claim for the income will not be till after the financial year end.
But don't we know what we're going to be claiming for and what we can claim for with regard to income loss?
No, because as I said, so for example, the parking income that we have lost changes depending on the lockdown. So if there's a further lockdown, so that's why it's not necessarily clear, because it's not pound for pound that you would then get back in. If we lost £1 in parking income because we were locked down, we wouldn't necessarily get £1 in grant income. And that's what we need to work through.
Okay. Thank you.
An issue of matching up the losses with the sources of compensation for those losses, isn't it?
Yes, but if we knew what they were now, that'd be brilliant. But because they're still changing and likely to change come the 18th of December, when further update on tiers is announced, then that's the challenge. And as Roger said earlier, the exciting times that we have to actually work through all the numbers and what it means.
Thank you, Caroline. Councillor Bembo, did you have a comment or question?
Thank you. I wish to talk about the theme subject on parking and the income losses. But if you look on page 12 under 2.27, and these currently for 4,991 cases of parking deaths. If you take into the account of the admin station plan to increase parking charges, surely there'll be a knock-on effect on people, you know, with the debt, and they will would it cause more problems with the income loss in the long run?
So certainly we are looking to progress those cases, and indeed we had sort of a meeting earlier this week about the steps that we want to take to make sure that we can look to move on those. There are still restrictions on what our bailiffs can do. They're still not allowed inside people's houses. They need to do risk assessments, and if anyone in the household is isolating or has COVID, then we come back in 14 days. So certainly being able to progress those will help the debt position, but we have assumed a certain level of income collection already, which is then reflected in the numbers in the table on page.
On page 35.
Yeah, and 35.
That's right. And what about in the future when the parking charges increase? And then would you expect to find more problems?
It depends on lockdown, because some of these problems are because we had to suspend our bailiff service. So we've only just started that back, but there's a backlog in the courts and being able to progress certain cases. So I don't know, David, if you want to come in to give a sort of the more definitive view, but
so, Caroline, Councillor, so the other thing that I recently found out, I checked in with the parking services team to try to get a comparison of the number of PCNs that they've issued in the 3 months prior to this most recent lockdown for this year compared to last year, so I could try to get an estimate of our workflow going forwards, and they're reporting about a 13% reduction just in the number of PCNs that they've been issuing. So I think it's inevitable that the income will go down, the number of cases that come through to the enforcement team will be less, and clearly we will struggle probably to collect the levels of income that we have previously on the parking debt.
Okay, thank you.
but some of those parking income numbers did show a reduction in future years in the budget, because we thought compliance would kick in, and we've got it in a different way.
Did you take the increases into account?
Yes.
Oh, thank you.
Perhaps we could just consider whether we have questions over any of the departmental pages. Page 30, we have the start of the corporate services section. Are there any questions in that respect?
I have a question.
Yes, Councillor McGrath.
So can I just understand the adverse variant on IT? Am I right in saying that this is page 31 at the second paragraph. So we did less printing, which meant that the IT department recovered less money from other departments for printing. Is that right?
You want me to answer that one, Caroline?
I said yes, but yes, if you want to give a further explanation.
So we have both internal and external printing, but yeah, there is obviously, because everyone's working from home, there's very little internal printing recharges, but they do some external as well. So both sources are down.
So if we're doing less printing, is there somewhere else, it may not be visible, where the fact that we're doing less printing is saving us money?
In the departmental budgets, there will be the saving, but obviously the bigger number is consolidated in IT. So in IT, it shows, yeah, but it's an internal, when it's internal, it nets nil.
Yep, that's fine. Yeah. Thank you.
Okay.
Thank you, Bindi. So perhaps we should move on to the section on environment and regeneration, where we do have some very significant figures. That starts on page 33, the foot of page 33, and goes on from there. We talked a little bit about the parking services adverse variance of 5.5 million. Does anyone have any other questions or comments? Okay, perhaps we should move on then to children, schools and families. That starts on page, Ed, yes, you have a question or comment?
It was on the, thank you, Stephen, it was on the children, schools and families section, if you're ready to move on to that, yeah. Yeah, it was just on the DSG, and I know it's a big topic, the dedicated schools grant and so on, this deficit that's grown, and it comes under the Children and Families Act legislation, where the previous form of statements now becomes EHCP plans and so on. But there's a statutory, I wonder if Caroline can update us, there's a statutory instrument, I can't remember the status of it, if it's now been implemented or not. But it was about how you account for DSG deficit. And if I understood it correctly, I know there's quite a complicated formula you have to work through and apply from a number of different years, but basically it said as of this financial year, so from 1 April, to the extent there is a deficit, then you're not allowed to book that in the revenue account, in the general fund, of course. So I think there's a recovery plan, and some of that deficit, which was significant, it was £12 million, I think, for this, or a bit more than that for this financial year, another similar amount for the last couple of years. But obviously you booked and budgeted and I guess accounted for in terms of a cost this financial year. And are you able to explain that? So in the context, have you now completed those calculations for the purposes of the financial instruments? And could Caroline kindly confirm, is there going to be some kind of release? And there might be a release in next budget year as well, because you have to have a recovery plan of 5 years, and I guess that's booked into the adverse cost, for next year. Maybe that's going to be released as well, particularly in the context of this financial year. Have you done those calculations, and are you able to comment, is there going to be some kind of release either from reserve, one of the reserves, I think you've booked £7 or £8 million in the general fund, for example, but is it, assuming you work through that statutory instrument, is there also going to be a revenue release for this financial year as well? Are you still in the process of working through those calculations?
So the statutory override is for 3 years, starting this financial year. So we have up till the end of 22-23, so March 23. We have not yet revised our estimates for the DSG, but the previous estimates that we took to Cabinet and have been built into the budget plan, at the end of 22-23, we were showing a deficit of £49.6 million. The statutory instrument, and there's been no further notice around what happens at the end of those 3 years. So up until that point, you can show it as a negative balance on your balance sheet. But come the 1st of April 23, we may then have to account for that. So we may have to suddenly find £49 million. So that's what we're still trying to work through around, what does that actually mean? Because our deficit recovery plan isn't a deficit recovery plan, it's a deficit management plan. Our deficit is increasing, and indeed in the page 44, you will see we're forecasting a £14.5 million variance, and that's increasing month on month as well. So we're waiting to get some updated figures to then see what does that mean for our DSG? What does that then mean for the monies that we have set aside, and how does that play into the statutory override? Clearly, the strategy that we had set out was referred to in the value for money statement for the external auditors for the final accounts for 1920. So again, if we were to change that strategy, we may need to have some discussions with the external auditor to ensure they're comfortable with what we're looking to do. But until we get the revised numbers, then we need to then see what that means and what can we release monies, or indeed do we need to top it up?
I think that's it. Yeah, I think everyone will find it very helpful just to see something in writing on that. But I think you just said, can you release money as a possibility? But I very much read that certainly for this and the next 2 financial years, you're not allowed to book cost for reference any deficit this financial year and the next 2 years. So therefore, because of that, so you just keep it as a separate sort of reserve, if you like, or a deficit reserve. I was expecting to see a 7-figure release both this year and probably next year as well, relative to the quantum of the recovery plan you've already put in the budget for next year, plus a reserve. So I was kind of thinking there might be release both this year and next year, but also release from reserves as well. So I was looking forward to seeing how that's. And I may be overly optimistic on that, but that was kind of my high level reading of the
statutory very optimistic on that. Very
great to see that set out in writing about how whether explicit dealing is like, if there's not going to be a release, just set that out and say so, or is there a possibility of one? Just either way, so we've got it quite a high level at the moment. But I appreciate it's a complicated matter, but it's also a very high value matter. So that's where I was coming from, basically. Anything you can give us in writing in the next set of papers, I think would be really helpful.
Well, there should be an update, we hope, for the January Cabinet papers, which will then come back through to the Commission.
Okay, Paul.
Can I just jump in there? Am I missing something, Caroline? Isn't the SI just about the accounting and not about money coming in? It's just where we put it in the account. It's not actually addressing the shortfall at this stage, is it?
No, and that's part of then the conundrum we have come the end of the 3 years, and they then say, okay, that was it. You had 3 years to sort yourselves out to get your deficit down. If you don't, you now have to fund it. We've then got a £50 million gap.
So it would be madness to sort of transfer in some pretend bonus because we put it somewhere else, we've hidden the debt. That would be a crazy approach, would it not? We have to actually keep at the forefront of our mind this debt at this stage.
We want to make sure that we review it and we have an appropriate strategy depending on the size and actions that are then going to be undertaken.
Thank you.
Yeah.
This is probably a very ignorant question for which I apologise because I find the DSG deficit rather confusing. But we're actually spending this money. The money in the deficit's increasing. We're spending the money. Where is the cash coming from? I mean, presumably if the money is, this money is all pouring out, where's it actually coming from? Or are we borrowing it somewhere, or is it reducing the reserves?
So a simple answer to that is we effectively borrow it from the future years grant that we get from the DFE. But we also need to keep that in mind as to the size of the grant that we get and the size of the deficit. So certainly we've shown in our accounts for 1920 a call on this year's grant of sort of 13 million. But as the grant is over 100 million, that's okay. But cash flow wise, it may get complicated because of the size of the expenditure that is still going out that door if it's not covered. So it will come into play in our cash flow forecast at later stages during our budget forecast. But in simple terms, we are forward funding it, as it were, or borrowing.
But I mean, we have to. Okay, I'm sorry to be missing the point. We have to hand this money over to the various providers, and they presumably this is actual money we're handing over. We haven't yet had the money from future years, so I can't quite see how we borrow against it or where that appears on our balance sheet.
You're asking for the kind of cash flow, the source, and
yes, I think that's right.
The application is to school providers. We're not quite sure where the source of that cash is.
Yeah, if I may, it's basically coming out of our working capital. The bank account. We if you think about the amount of bank balances we have through our treasury management activity, you know, we have reserves, etc., etc. All of those are cash backed. To that extent, where we're using our cash balances.
That was really my question. So our actual cash, is going down. So when we said we've got an adverse variance of 14 million, we got 14 million more or less actual cash than we would have had at the beginning of the year if we hadn't had this variance.
Indeed, yeah.
And if I looked at the balance sheets, if that's the right place to look, I'd be able to see that.
Yeah, I mean, obviously it's a highly complicated business, but it's somewhere within there that we are down in terms of cash, having to pay across for these issues.
And what then happens? Because okay, fine, fine. I think I'll have another read, and I may come back with some questions.
Okay, fine.
Thank you.
Yeah, if I could just chip in again on the same show, I appreciate that this statutory instrument is only for 3 years, but that's because there's going to, you know, people anticipate and the government anticipates address of this issue during that time. I don't think there's any, you know, discussion anywhere that apart from here, it seems that there's going to suddenly be a large bill in, you know, year 3 1/4 that you're suddenly going to hit this in the revenue account. I mean, to me, this is actually a very significant, because the law basically says you can't, you know, account for it within your revenue budget as a cost. You're not allowed to, because it's going to be dealt with at some stage separately outside of that, and there's no adverse risk on yes, it's paid for within working capital, but it doesn't in any way compromise the working capital, and the auditors are, you know, so it's, to me, it's actually, it does say, because you have booked effectively a recovery plan, and that recovery plan makes assumptions that over the next few years, I think 5 years effectively, so when you set out your projected losses and the budget shortfalls for the few years ahead, you've got a low 7-figure number in there. You've got a 7-figure sum each year in that number that represents the annual contribution towards a recovery plan for the DSG. But the law now says, well, seeing the statutory instruments passed, you're not allowed to book it either this or the next 2 financial years. So to the extent you had included a cost or part of the recovery plan during this and the next 2 financial years, then there's no doubt about it in my mind that what the statutory instrument says is you're not allowed to do that. You've got to keep it separate. Do not let it adversely impact your revenue, because why I keep saying until we see this really set out, I'd still be asking the question, is there going to be a release certainly for next financial year and the one after that? Because I think you set out your recovery plan, so you've projected a cost, and there's probably a 7-figure cost. If you divide 12 or 25 million by 5, you can see how you get quite a significant cost projected into the next few years, and that's what the statutory instrument to me seems to address anyway. But I appreciate there's quite a bit of uncertainty about it. That was my reading of it anyway.
Right. So just to clarify, our deficit that was previously reported at the end of the 5 years was £66 million.
And are you happy, Caroline, that the government have said that we don't need to worry about this?
You're not allowed to. It's not that you don't need to. You're not allowed to. It's what the law says.
No, what they have said is you cannot fund it from your general fund.
Exactly.
What they haven't said is they will fund it, and therefore you do not need to worry about it. And indeed, for some, the DfE have gone out and visited some authorities, and their first question has been, what reserves have you set aside for it?
So we could set reserves aside for it if we wanted to.
We have been setting aside monies to offset that deficit, and I think within the budget plan we show the increasing deficit on the DSG up to 66 million, and we had a reserve that offset it. So we've kept it separate, because as soon as you put money into the DSG, my fear was the government would say, well, that's it, thanks very much, you don't need any further money from us. So we're not doing that. But at some stage, our deficit, and therefore negative balance on our balance sheet for earmarked and unearmarked reserves, will be higher than our earmarked reserves. That's not a financially sustainable position for the authority to be in.
Okay, thank you.
Can we just commend Caroline? That's the right approach. Goodness me.
Well, we'll see, because it's an expensive approach until we hear for definite that the government and DfE will fund us.
Yeah. But we're setting a revenue budget. What we're heading towards now, of course, is a budget for the new financial year, which is primarily a revenue budget. And this law says you're not allowed to take adverse costs. within that for this and the next 2 financial years of any DSG deficit, I think. But anyway, yeah, we'll see how that pans out. Okay.
I don't want to create work for Caroline, but I just wonder whether a note circulated subsequent to this meeting, a written note, an email, setting out exactly the council's approach would be helpful to all of us.
So, Stephen, we're looking to do that update as part of the Cabinet report in January, because it will feature as part of the budget report. So there's a section already in the December report which said we need to do some further work on the DSG because of what we've done so far. We need to review it, and then that will be set out in that January report.
Okay, excellent. Thank you very much. Let us then move on to the community and housing section, which starts on page 48. Take it we haven't any questions on that section of the report. The capital programme, are there any questions arising on the capital programme?
Chair,
Yes.
It's on page 56. It's not altogether surprising, but against the planned expenditure, we've actually committed just around 10% to September. I guess my question is, to what extent are we likely to end the year, in fact, very underspent on the planned capital programme?
I don't know if Zoe wants to answer that, because it's what people plan to say they spend and how much we fund it. But Zoe, do you want to say about the work you've been doing here?
Yeah. What happened is we spent quite a bit of time, or we have been spending quite a bit of time with budget managers talking through their projections. And if you look at later reports to Cabinet past September, we've had quite a substantial amount of reprofiling through to future financial years. When we actually pull together the capital model, we do assess what we actually think is going to be the outturn spend for the authority for the year, and we actually utilise that to then as to how much we are going to fund and how much slippage there will be. So we always realise that budget managers overestimate how much they're going to spend. At the moment, at September, it would appear they are very much overestimating what they are going to spend. And the model that I have is allowing for that in my projections. So I think probably at year end, they will spend between about 18 and 20 million at the moment, because we've just had November spending, which is 1.362 million. And if you compare that then to past year's spend, it's, I think, 10 million behind some years, and at least about 6 million behind the other 2 years that we compare it to. So yes, spend is definitely low, and we are allowing for that in our forecasts.
Thank you.
Thank you, Zoe. And indeed, Peter, if you looked at the business plan update, which went to Cabinet on Monday, there's a further £1 million adjustment to the budget gap because of the slippage in certain schemes and also some additional funding we've got through.
Thank you.
Thank you, Zoe. I think we can now, as it were, go back to the beginning of the pack and look at the debt update. That's on page 9. I think it's very interesting on page 13. We have a comparison year on year, and at September 20, the debt was 38.9 million. At September 19, the debt was 37.4 million. So it's year on year by 1.5 million, that's probably not good. But actually, in the circumstances we are in with COVID and so on, I'm actually quite pleased that that increase isn't bigger. But anyhow, do colleagues have any questions they would like to ask?
Stephen, I think just to endorse the point you're making there, and I mean, at the macro level, the figures are remarkably stable, aren't they? Which I think is, well, it's whether that's through careful management or good fortune, I don't know, but they're reassuring.
David would say his careful management.
Good fortune, councillor, I think. Can I just highlight a couple of very quick things on that, Chair, on the report? So council tax, just a very quick update, 2.3 through to 2.8. At the end of September, we were reporting a shortfall in income, and that contribution for Merton was 2.19. We've just completed November's figures, and there has been sort of very little movement on there. Council tax were about 1.89% down collection on this time last year. Business rates, there's been a better position. So whilst our collection rate is 9.3% down on last year, the actual shortfall for the council is just over 1.7 million. So earlier on in Caroline's report, it showed the shortfall of council tax and business rates as at the end of September. There's been about a £300,000 improvement since then, as at the end of November. I mentioned earlier on, we actually today had our first virtual court hearing, only the second of all London authorities to have one. And just to sort of highlight the benefit of issuing summonses, we issued in the region of 1,600 summonses to residents who hadn't complied with all instalments, and in fact some hadn't paid any instalments at all. We had quite a lot of correspondence and phone calls coming in, but we actually had 130 accounts that were paid in full for the whole year. So that's not just making up the missed instalments, that's paying the whole year's council tax plus the summons cost. Roughly, if we're talking about an average of Band D being, I'm not sure I should know it, about £1,600, the accountants on it can probably work out what that sort of extra income revenue is just for the issuing of the summons. So certainly what we find with when we issue summonses, we get that increase in income, and then we also get a lot more residents paying their monthly instalments going forwards.
Good result.
Yes, Paul. Well, Councillor Kohler.
Yeah, thank you. David, I'm very supportive that we're making those who can pay. I think it's absolutely critical. And in terms of the business rates, you mentioned in paragraph 2.13 how supermarkets and those that could pay hadn't. Has that changed now? Have we got, of those who we think should be able to pay, has that money been received?
We certainly started issuing reminders, and the approach that we took, councillor, was we encouraged businesses to contact us, those that couldn't pay. We've deferred approximately at the moment, I think about £700,000 of business rates due this year. We've deferred that into next year. And certainly with those reminders, we targeted some of those businesses that I think on the face of it should have paid, and hopefully now that they have. So if any of them haven't paid, the next approach really is issuing a summons and trying to get them into court. But I think across London, the courts certainly aren't keen on business rates summonses, and I think there's probably so at the moment the courts won't entertain any business rate summonses. As I say, we're very lucky that we've had a council tax liability or hearing order, but we are targeting those businesses that should have been paying, and we're trying to help those that are clearly struggling. We're deferring their instalments, as I say, right into next year.
And if we do have a problem with those that should be, who can pay and aren't, do we ever use publicity to just shame them, or is that thought of as being unacceptable?
We haven't in the past, councillor. I'm not sure how that would fit with GDPR and because you're issuing public, you're issuing private information against up to the public. I mean, it's not something that we've done.
Okay, thank you.
Thank you very much. I think we all received an email from David last week concerning a very significant debt. Choice of actions now. Given that this is work in progress, managing this debt, we can either note the fact that we received this email from David and ask him to update us either at the next meeting, where something significantly happens by email between meetings. Alternatively, we may say, well, we want to ask questions about what is happening here. If we take that decision, then I think we're probably in an exempt topic, and we will have to defer it to the very end of our meeting this evening. So my question to colleagues is, are we going to note it, or do we want to question it at the end of the meeting? Perhaps a show of hands. Who is in favour of noting? 3. Who would prefer to question David about it? 1. Okay, well, on that basis, we'll note it. And David, if you could update us at the February meeting if something significant happens by email when it does occur, if it does occur.
Certainly, Chair.
Thank you. I think that probably concludes our examination of the Q2 report, unless I've missed something out or anybody wishes to ask a other question or comment. No? Oh, sorry.
Just my question about apprenticeships, we're going to cover that separately, aren't we? Because it does come out of this report, but...
Yes, that's the next agenda point, actually. So we now move on to the part of the agenda I inserted, which is any other business and Paul's suggestion. First of all, are there any other business matters? No. Okay. Now, Councillor Kohler has suggested to me that we should look at the funding of apprenticeships at the February meeting. And this stems from the Ofsted report, where it was said that the council needs to do a little more to strengthen our approach in relation to criminal exploitation of youth. And Councillor Kohler has made the point, well, apprenticeships is an acknowledged way of helping the youth of the borough, and maybe we should look at the funding issues around that and the costs around that, etc. Paul, is there anything you want to add?
No, hardly anything more. I don't want to delay things. It's just, I was prompted by paragraph 2.5 on page 21, where the apprenticeship data is not recorded. I don't quite understand why it's not recorded. I can read what it says, but don't fully understand why it wasn't recorded. But I think we need to look at this because this is crucial. And if we are giving money back to the Treasury, I don't know that we are, I think that's something we need to address because that's money we should be spending on our youth or businesses that can employ those youth. It doesn't have to be us. I don't know if you want to say something, Caroline.
So I suppose just to say, unfortunately, we can't use the levy to actually pay for salaries. So it can only be for the actual training itself, which we keep saying that's wrong, because we should be able to use it for that. We have done a lot of work with our schools and to make sure that they can access it. And also there are courses that haven't yet come out. I think we've waited 2 or 3 years to get a social care training course as an apprenticeship level. So we are trying to maximise it as much as possible, but we've struggled to get some of the courses required to actually help us, because we've also looked at our long-term agency to see could we grow our own. And certainly I think we've had previous discussions to say that We have, I think, about 5 legal apprentices who are looking to train, who therefore won't have university debt. So that's a win-win for us and for them. But I think there may have been some instances very early on where we weren't able to find the training courses required to maximise it. But we are really looking to do that as much as possible. But being able to use it to fund apprenticeship salaries would really help.
No, I fully appreciate that, but to actually see if we could get a grip on the size of the issue, what money we're talking about, that will help us all concentrate our money. And of course, talking to employers within Merton who we could divert money towards training from that levy, as I understand it. That would all be, again, if we can raise the profile, I think that will help us address what at the moment is just money going back to the Treasury.
Yeah, so Sarah Xavier in Chris Lee's department has been working with businesses around maximising their use of the levy as well. And I was just trying to see, I did get some information on apprentices, but it may be better that we have a proper paper for you.
That's perfect. Thank you.
I think the proposal is we have a deep dive on the 16th of February. Our colleagues, that's the idea. Okay, that's what we'll do then. Thank you. So we now move on to the Malden Town Centre regeneration. This is the public part of the meeting still, please bear in mind. Who is leading on the public paper, as it were? Is that Paul McGarry or?
Hi, Chair. Yes, I'm happy to do the introduction for the public session.
Okay, super. Thank you, Paul. Please go ahead.
Okay, thank you, Chair, and good evening, members. The report included in the open agenda pack provides members and the public a summary of the investment and funding plans that are needed to support the delivery of Malden Town Centre regeneration. The regeneration of Malden is a key priority for the Council and has been a long-held desire for residents and local councillors too. Council officers have been working in partnership with Transport for London to facilitate the delivery of a comprehensive regeneration of Malden Town Centre, which we hope will stand as an exemplar for sustainable development, low carbon and potentially a post-COVID town for the 21st century. These are shared objectives between Merton Council and TfL's commercial property team. TfL Commercial Property are still heavily committed to the project because developing their assets, as like us, is a way of boosting their financial resilience. The regeneration of Malden and the principles are being captured in Merton's local plan. The plan seeks to deliver a vibrant town centre with 2,000 new homes across 8.4 hectare sites. The project will create a renewed high street, a renewed workspace and business offer, new public realm, new bus interchange designed to mitigate the poor air quality that exists currently in Malden, and to support the delivery of new public space at the heart of the town. This will be a benefit for existing residents, businesses and commuters, as well as our future residents. Merton Council and TfL are the major freeholders in Malden. However, hidden underneath that, there are over 350 individual leaseholds that still have to be acquired to enable us to deliver the comprehensive regeneration needed for Malden. To put that in context, because 350 is a scary number, Malden was built in 1926, between 1926 and 1936, when the Northern Line arrived, and it was all built by London County Council. Therefore, the majority of the 99-year leases that were granted then will gradually revert back to Merton Council over the next 15 years. The Council has a choice. Do we wait for possession of those leases and watch Malden decline further for another decade, or do we actively seek funding to support those land acquisition of the leases, which would then de-risk it for a development partner and allow us greater control in the comprehensive development of Malden. The Council and TfL have been working with the Mayor of London's team to secure external funding to support the land assembly element of the project. That was about an 18-month piece of work looking at the Homes for Londoners Land Fund. In March 2020, the GLA advised that the fund was oversubscribed, and with the potential COVID impacts on the industry on the horizon, the GLA reprioritised allocation of funding within that fund to other projects which would deliver housing quicker than the Malden project would be able to. So in effect, the GLA put their investment towards less risky schemes. Now, when I say less risky, that means sites that were already cleared or ones already had planning and could deliver housing quicker for the mayor. So Malden just didn't fit within that timescale under the reprioritisation. The report also sets out the revenue and capital allocations within the E&R budgets, and that's on section 6.7 in the public report. The revenue budget of 184,000 is contained within Future Merton's team budget and has supported the running of the projects, as well as the due diligence and preparation work, which we've done and funded in partnership with TfL, which supported the external funding bids. That work is not wasted. It is still very relevant as we progress to the next stage of the project. In the capital budget includes a £300,000 allocation over the next 2 years, and that is funded by SIL, Community Infrastructure Levy. And the intention there is it allows us to invest in short-term improvements in Malden now, whilst we focus on the big scheme. We want to invest in Malden now so it doesn't decline and we can support businesses through recovery. So we're beginning to scope those ideas out now, and we'll be in touch with local councillors in the new year about how we may allocate that fund. The remaining £6 million capital allocation is intended to act as a match funding from the council for any external funding we get. So although you do see a funding profile in the capital programme, then we keep that under review in terms of the timing, because we don't intend to spend it unless it's to match other funding which we get in. So with Caroline and Zoe, we're often retiming that and watching the slippage on it. So it's always under review. James and I will be happy to expand further on the funding and the alternative delivery options for Malden, but that's commercially sensitive because it underpins a procurement exercise. So I think I'll pause there. If we can take any questions in public, we will. Alternatively, we can leave to the private session. Thanks.
Colleagues, do you have any questions you feel is appropriate to this public session? I have a question of my own. We have the 350 leases, some of which will no doubt expire soon, and therefore we get the land back at kind of no cost. Others will have a long run out, and potentially we may want to buy them for good reasons to help the regeneration project. In kind of principle, how do we make that decision? Which ones do we buy and which ones do we allow to just expire?
Yeah, so obviously not all the leases are coterminous at the same time. It's quite a mixed bag picture. And over the years, some people have extended leases, some haven't. 350 sounds a lot, but if you imagine London Road or any part of Malden Town Centre, you get 3-storey buildings. Quite often that single plot would be a shop, a flat and a flat above it. So often one plot is 3 leases. So 350 leases is about 100 individual plots. We have mapped that, so we know where all the plots sit, and we have mapped when the leases are expected to run out. So that can give us an indication as to what part we may choose to either upfront invest in and buy back, but we don't have budget provision for that ourselves. That's why we're looking for external funding. The rationale behind TfL and Merton working together on that is if we fund the land assembly up front within the public sector gains the land value uplift. So that's in essence why it's a land assembly project before it's a regen project.
Sorry, James, yes?
Just add that you asked, I mean, it will be very much on a case-by-case basis. If there's a business case for each leasehold or freehold interest, the leases do date back to the days of London County Council. Some are within the Act, some are outside of the Act, so there is security of tenure for the occupiers, but it is very much on a case-by-case basis. Caroline and Chris have asked us that we should examine possibilities, but there needs to be a sound business case, and that business case includes what are the holding costs. Do we do them when they're pulled together, assemble a chunk of land as opposed to pepper potting? So each case would be looked at on those merits, but with a view to seeing whether or not there's a meanwhile strategy as well that would mean that we weren't sort of buying dormant properties.
Okay, thank you. Councillor Bembo, then Councillor Kohler. Nigel.
Okay. Is it possible to explain more on section 2.9, which which is on page 76, you mentioned it'd be 50-50 split partnership between TfL and Merton. How is this going to work? Because I'm thinking about TfL have got problems of their own at the moment. They're about to see a second payout. But and also if you could explain this with the paragraph on 2.19, which is your plans over 2 years period, please. Thank you.
Chair, can I answer? I appreciate that the intention is to put as much of this in the public domain, but I think in answer to Councillor Mbo's first point about the equity split and TfL, I think that's probably one that we'd seek to answer in the closed session, if that's okay with you.
That's fine. We'll carry that forward to the private session. Councillor Keller. Thank you, James.
Sorry, can I add in on the second question of Councillor Benbow, which was the SIL monies mentioned in paragraph 2.19. So we've only just recently approved that spend. So the Future Merton team will be putting ideas together. We haven't done that yet, but we'll be doing that before Christmas. The intention is looking at any meanwhile uses, anything that supports the high streets, post-recovery, anything that we can do to tidy or freshen up Malden in the short term. So we will put together a list of suggestions, and we hope to engage local ward members on that. That will also include at some point community engagement and business engagement. So we have fed that back to the Malden councillors in a separate briefing. So hopefully in the new year we'll be able to define what we can do with that money. That fund, although it's allocated, it actually isn't real until April. So it's in next year's budget. So we have a few months to scope out how we may choose to spend that.
Thank you.
Thank you.
Paul Kohler, Councillor Kohler.
Thanks. James, thank you for your previous answer, because I was going to ask about security of tenure. So some are within the 54 Act. That shouldn't be an insuperable problem, should it? Because redevelopment is an exception to the 54 Act, isn't it?
Yes, it is, and that, along with we've always been clear that it might need to be underpinned by compulsory purchase as well. But yes, the 54 Acts, as long as there's a demonstrable development about to happen, then if the security doesn't hold because it's usurped by the but that's actually having more than just a planning approval.
Thank you.
Any other questions? No, I don't think there are. So I think we've concluded the public section now. So we'll now be moving into private session. Rosie, are you able to